Afternoon, guys. Thanks very much. You guys talked about some of the seasonal factors and product shift changes with customer acquisition costs, but I'm wondering, is there anything going on at the unit level, or have you seen any changes to origination fee structures in various products, and or are you exploring different channels of customer acquisition? Anything going on there just to talk about that piece of the business?
No, and no large fundamental changes there. I would say we still use the sort of full range of marketing channels that we used before. We've made improvements across many of those, leading to some of the wins and better than seasonal numbers that we've had. We have largely we talked last quarter a lot about our intentional strategy not to max out on take rates from borrowers, and we've stuck to our strategy there. So we are very intentionally not maximizing profitability of the business. If that was our North Star short-term profitability, I think we could have a lot more of it by squeezing more out of take rates and in fees, especially in certain segments. But that's not our strategy, because we don't think that is the best way to maximize the long-term value here. We think there's just incredible value associated with winning over customers and in building relationships with them and leaving a little bit of extra on the other side of the table. So we've been doing that. We've stuck to that strategy with respect to how we think about origination fees, and when we go out and do marketing, we certainly keep in mind that it's valuable to win over a customer, and it's not all about maximizing the profit on day one.
And then with that in mind, any comments on whether it's recurring customer activity or maybe even thinking about is direct to customer activity or cross-sell, any kind of signals you're seeing there?
Yeah, we certainly do both. We think it's really important to have a lot of repeat customer activity. We are increasingly focused on what we think of as returning user activity. So, these aren't necessarily people that got loans with us before, but you look at that 20+ million number. Those are all people that have decided to come check the rate from Upstart at some point, and maybe they couldn't get approved the first time. Maybe they couldn't get the sort of type of loan or the dollars of loans that they were looking for the first time, and so they didn't accept. These are all, perfect candidates for people as we've got more and better products to go back to. And so certainly we do more and more of that, and that's something that we want to maximize. But we're also still so early in our growth journey. 20 million is just a fraction of the US population, and as the player in the market that uniquely we think can serve the entire spectrum. From having great rates for people on the very prime end to having great offers for people at the other end of the spectrum. We think we can be sort of a full spectrum offering. And so we think our addressable market is a lot more than 20 million Americans. And so we want to keep adding new people into the database, and so we're going to keep marketing to do that. And that you put those together, and I think in the long run you're going to have a very, very valuable business.
Good afternoon. Thanks for taking the question. Just wanted to go back to the bank charter. Could you walk us through maybe some of the key regulatory milestones ahead there, and what's the expected timeline before you start realizing some of these operational and financial benefits that you talked about? Thanks.
Yeah, we're excited about the bank charter. As you mentioned, the benefits are primarily regulatory. So just to clarify in case that was lost on anybody, but we expect to get nice improvements that are both operational and financial out of doing the bank. But it is not a balance sheet strategy. It is not something that we're doing to change how we fund loans or how much capital the business needs to operate. In terms of process from here, we have submitted our application with the OC. It's for a national bank charter, and we're working with the OC on pieces of that application. We don't have any specific guidance on the exact timing of this. That's going to come in our work with the regulator. But we're very motivated, and I think the regulators have been really constructive in how they've worked with us and other companies in this current situation.
Okay, great. Then maybe just a quick one. You bought back 100 million of stock in the first quarter. I think you have like a little over 100 million left on the authorization. How are you thinking about the pace of buybacks, I guess, throughout the rest of the year? And how do you balance that kind of with some of the balance sheet co-investment and new product funding needs? Thanks.
Yeah. I'll go back to saying that we think capital efficiency is really important to us. We want to think of equity capital as a real cost. We want to think about metrics in per share terms as often as we can. And so in the long run, we're just going to be thinking about how do we maximize the earnings of the business and how do we minimize the amount of dilution in the business. And so whenever there are opportunities, afforded by a combination of considerations of, available cash and liquidity and financial outlook, and the price is right, we're going to be looking at an opportunity to use those stock buyback dollars. Now having said that, the reason we aren't always buying back all the time is that we just have so much growth ahead of us that the threshold for doing that is really, really high. We know that there are so many growth opportunities that we can invest in operationally that our threshold for using cash for any other purpose is going to be really high. But yeah, once in a while, I think we'll have that opportunity in the market, and whenever that is, we will certainly consider doing it.
Hey, good afternoon. Thanks for taking my questions. I wanted to follow up on the bank question. And I actually wanted to focus on the economic implications of becoming a bank. I thought it was interesting on Upstart's blog post when you highlighted about 200 million of annual frictional costs and also the lack of being able to be in certain geographies or serve certain customers. I wondered if you could elaborate on that. How difficult is it, and could you really remove 200 million of annual frictional costs? That would be big versus your IBA guidance of the 294 million. So just kind of wondering how difficult is it to achieve those things? Do we see that in economics in terms of EBITDA, or does it come from higher transaction volumes or some combination? Thank you.
Yeah. So a lot of that 200 number is really in missed opportunity on the revenue line. So I think it might show up in different place than you would think if you were just thinking about these as true kind of like friction costs. But the way it manifests is a few different things. The first is that we have a number of states and segments of the market where we can't operate, or we're limited in how much we can operate because of state-level regulatory issues, and having a national bank charter to operate through resolves most of those and gives us access to sort of the full market up to the 36% rate limit. So that's a big deal. Well, that's just TAM that we're missing out on today that directly gets solved by having access to the national bank charter. The second issue are direct kind of operational and financial costs associated with the way we operate today, and that is we originate loans through a large network of many financial institutions, and that comes with both direct financial costs that are paid or earned by the financial institutions instead of us, or the cost of friction and managing that sort of complex system of many players originating. And then the last is, so those I would say are the kind of really concrete costs that go into that 200 number, and then there's a separate thing which is more of an intangible, doesn't go in that number, but I think it's just as important, and that is that it's obviously we think a decade where there's going to be substantial advances in AI, that AI is going to do a lot to transform consumer credit, and I think every regulator is going to naturally be asking questions about that, wanting to understand that, wanting to work with the leading frontier companies in doing that, and we just felt that from our position as the company that's been doing this longest, we should have a direct relationship with the regulators in helping them understand what it means to apply AI in the context of lending, help them get that right, and do that directly as opposed to trying to do it through a large number of intermediary financial institutions.
Good afternoon, and congrats on the results. As the first question, last quarter you mapped out, an expectation of around 100 million of revenue from Hilo and Auto between, a ballpark 4% upfront take rate and 2% servicing. Is that still the rough expectation? And then when I think about that, one thing that I noticed this quarter is that, within the servicing line item, there was a step up in kind of the other fees, to which has historically been de minimis. It's closer to 3.9 million. Is that anything related to servicing some of those, Helic auto loans, and how should we think about that going forward?
Yeah, thanks for the questions, Juliano. So on the first point on the 100 million or so fee revenue from auto and secured, that continues to be sort of in the right ballpark in terms of what we expect. The sort of the take plus servicing that Sanjay spoke to last quarter represents more of, I would say, sort of the medium-term take rate for that product set in aggregate. So, may or may not fully achieve that inside of 2026, but sort of more over a 1 to 2 year time horizon as those products grow and scale. And on your second question on the other fees and servicing, I might need to follow up with you on that one. But I can certainly do that.
That's very helpful. And then think from an execution perspective, as you sell more of those loans and you flow through more through, should we expect servicing fee revenue to be, an incremental driver, especially on the margin side, because you're probably spending disproportionately on, marketing and other expenses on the front end. But then a lot of the revenue from the growth of those new products is really deferred and realized over time.
I think I'm understanding your question, and yes, that would be the case as we sell these loans through. It will, in terms of how it impacts revenue, will allow us both to recognize kind of fee recognition or take rate up front upon the sales of those loans. But especially on our auto product, where we expect to have a higher proportion of the compensation come from servicing, we will also be generating a servicing revenue that will recognize over time and will offset those servicing costs that we bear.